Right, so there's our long-term day chart. There's the triple bottom, the breakout, the rollover on that contract in April this year, rolling up, moving up much higher, up to above 3, back down to the 786 to the squiggly line, the rollover gap, tested the top of the gap, tested it again for the second time. Always expect a second test, no matter what you're trading. If you don't get the second test, you don't get it. But if you do get it, it's normally the right one. And it's the best one to trade. Second test, slightly lower, still not reaching the bottom of the gap, then gapping up and then up to where we are, another little gap over there, and we're just dribbling back down again. Still very bullish. My line in the sand for natural gas is $2.50 on the Henry Hub price at the NYMEX. Thereabouts in this pink sort of blockish zone or pink level. It's a very, very important key level, has been for years and years and years. And it's also been respected in our recent trading cycles. Every time we get there, there's some sort of reaction. In this case, we just had basically a fair value gap, if you wish, straight through it on that occasion. But most of the time we reacted in some way or another, either through a gap or a rollover, support or resistance. And on this occasion, we've got the 100-period moving average, the 50 creeping up to there, and we're moving back down to that sort of level right now. It's also, if you look at the last rollover, just slightly below the last rollover gap from the last contract. If I draw an ellipse from contract to contract, there's the previous contract that we were trading in, and we're now in the next contract, like that. And you can see we've broken pattern from the previous contract, which just kept on going up. This contract has failed to keep rallying, and that's because it's run out of gas. It's exhausted. Also, of course, there have been all sorts of hurricanes and weather conditions which have been adverse to natural gas transport, production, distribution, whatever in the US, particularly in the southern states. So what does this mean? I still think that even though we've had all this weather, although we've had pretty negative sentiment from the market, generally people looking to sell rallies rather than buy dips. Despite all of that, I do think that this downward move has been rather muted and not very impressive. I think that this is dribbling down rather than surging down, and that we'll find support somewhere around about where we are now. Despite having broken down through that short-term red trend line, this is the key area, around about the 2.5 level, down to about 2.2, down to about 2.45 in that region, and also with 100-period moving averages and the red 50-period moving average curling up. That'll meet us all up in the same price at the same time in the next day or two, and that should provide a good support platform for natural gas. Overall, this general picture looks good, fantastic. All we need now is a new high, a higher high. So we've got a low, a higher high, a higher low, and now we need a new higher high if this price is going to carry on moving up into the next season. I think we could get that, but I think we're going to have to gather some liquidity, some support, some base, build something, some structure from which to launch. And that structure could be a very dramatic spike, or it could be a slow, gradual basing pattern. It could be what we just looked at on gold, for example, or was it gold? Can't remember. One of the other ones, a smiley face and a cup and handle pullback, that sort of thing. But we need something to form here to form the next base or structure for this to launch from. As I said, it could be a very dramatic and quick spike low, or it could be a more gradual basing formation. Don't rule out a move down below 2.5. I know a lot of you have been, I don't like to use the word FOMO-ing in, but I know that happens, and I know some people that have done that. So don't FOMO into this. Don't rely upon this market moving up. It's a natural gas market, actually has a propensity to remain trapped between $2, $2.50 and $3.50. That's where it's most comfortable. So whilst we're in that region between $2.50 and $3.50, or $2 and $3.50, we're trading within a range. And when we move towards the higher end of the range, like we have done now, it's likely to move down rather than move up. So don't be expecting that natural gas is just a bullish market like the NASDAQ or the S&P or gold or whatever it might be, Bitcoin. This is not that sort of market. Be prepared for this to thrash around, move around, try and form bases, get spooked out one way or the bad conditions in weather, economic conditions. Remember, if the economy crumbles and collapses, I don't think it's going to, but if it does, and it could, I don't think it's going to, then natural gas will be affected by industrial output, affecting demand for energy in industry, and natural gas being one of the predominant sources of energy for industry. So in a recession, natural gas gets beaten back. Right, I'll show you my Black Bull chart quickly. This is where I trade the futures contracts at Black Bull. And there's the same support level right there. In this case, it's, I suppose you might call that yellow, but it's more orangey than yellow. But that orange-yellow block, notice as well, there's the 100-period moving average. We looked at the Henry Hub chart last time. This is the broker chart reflecting the price from the Henry Hub, natural gas price as provided by the NYMEX in real time in this case. So we could get that back down into that 2.5 level and these moving averages. So that's looking okay. I like it. And in fact, if we draw a Fibonacci on there, which I haven't done, it will be a Fibonacci level 2. I guarantee it. So let's put a fib from the bottom to the top. And you can see it is, in fact, the 50% retracement, which is not a Fibonacci number. It's in the Fibonacci sequence for convenience, but it just means a 50% retracement. The market often retraces 50%. And that's exactly at 2.5. So that is the Fibonacci, and the 50% retracement of the move up from the bottom being at 1.8 something, the top being at $3, the 50% retracement, about 60 cents, takes us down, about 55 cents actually, takes us down to the 2.5-ish level. I'll be looking for a reversal there to add to this long position. I've still got plenty of space to add. I don't have a full position on natural gas just yet, but I'm aiming to build up into a slightly bigger position if the market allows. Natural gas is incredibly dangerous, and it's probably the instrument that I've encountered the most with other traders getting damaged the most or hurt the most in their trading through natural gas. It's just one of those instruments that you need to be really good at or very careful of, or both, when you trade it. And it's not really for beginner traders. And unfortunately, because of the nature of the volatility and the big swings and the big intraday moves, 5–10%, many new traders start out with natural gas not being aware of the fact that they're probably going to lose all the money that they put into their trading account if they're going to try trading natural gas. It is the most difficult commodity to trade. Not only that, because we've got monthly rollovers. Every single month we have a rollover and the price adjusts. We get contango, backwardation to deal with, rollover gaps and prices. The way your broker deals with those rollover gaps, every broker deals with them differently. It's incredibly difficult to trade. And if you do want to trade natural gas, I suggest you join our private group. It's free for 30 days. I don't know why you wouldn't do it. The link's below. Sign up for 30 days for free of charge. After that, if you don't want to carry on, you can just stop. You won't be charged a penny. And maybe you'll pick up something about trading natural gas that you didn't know that might help you. Really looking forward to it, and I hope to see you in every one of them.